Most people think currency devaluation is a complicated economic phenomenon that only experts can understand. But at its core, devaluation is surprisingly simple. It's the silent shrinking of your money's power. You don't feel it in one sudden moment. You feel it slowly, through rising prices, shrinking savings, and a lifestyle that becomes harder to afford each year. Currency devaluation happens when governments increase the supply of money faster than the growth of the economy. When more money chases the same amount of goods, each unit of currency becomes less valuable. It's the same as printing invisible money into the system. Even if no physical notes are printed, digital money expands, government debt increases, and central banks dilute the purchasing power of every currency holder. But the real trick is this. Devaluation is often presented as a solution. Governments say it helps exports, stimulates the economy, and reduces the real burden of debt. And while some of that may be true in the short term, the hidden cost is paid by ordinary people who see their salaries stagnate while the prices of food, fuel, rent, and basic goods climb. This mechanism works like a quiet tax, a tax you never voted for, never saw in your pay slip, and can never escape. Your money loses value while assets like real estate, gold, stocks, and commodities rise. Those who own assets get richer. Those who rely on income get poorer. Devaluation doesn't take wealth from the economy, it redistributes it. It shifts economic power from savers to borrowers, from the middle class to the elite, and from wage earners to asset holders. And the most dangerous part? It happens gradually, silently, and often without public understanding, which is exactly why it works. Most people imagine losing money as something dramatic, a market crash, a bank failure, or a major financial crisis. But the most dangerous loss of wealth doesn't happen in a single moment. It happens quietly, slowly, invisibly. And the weapon behind it is currency devaluation. When the value of a currency drops, your money doesn't disappear. It simply buys less. The number in your bank account stays the same, but what that number means changes forever. This is why inflation is often called the silent thief. You feel richer because your salary increases on paper, but your life becomes more expensive at a faster rate. Governments often frame inflation as a natural economic cycle, something inevitable. But in reality, inflation is frequently the result of deliberate policy choices, printing more money, stimulating demand without increasing supply, or weakening currency to boost exports. The most dangerous part? People don't notice it happening until it's too late. A cup of tea that once cost 10 rupees now costs 20. Rent climbs every year. Groceries become slightly more expensive every month. Over time, this compounds into a massive loss of purchasing power. What your parents could buy with a day's salary, you can't buy even with 3 days' salary. This erosion doesn't hit everyone equally. The wealthy store their money in assets, real estate, stocks, precious metals, which usually rise with inflation. But ordinary people store wealth in cash and savings accounts, which lose value every day. You work harder, save more, yet feel poorer. Currency devaluation creates an illusion of stability while slowly draining the financial future of the average person. And unless you understand how purchasing power erodes, you can't defend yourself against it. Most people think they understand inflation. They believe it simply means prices are going up. But the truth is far more dangerous. You are not just paying higher prices. Your money is quietly shrinking behind your back. This hidden erosion of purchasing power is what makes currency devaluation one of the most powerful invisible taxes ever created. Imagine earning the same salary year after year while everything, food, rent, fuel, healthcare, keeps becoming more expensive. You are working the same hours, doing the same job, but somehow getting poorer. This is not bad luck. It is not mismanagement. It is the mathematical outcome of a currency that loses value faster than you can earn it. Purchasing power is simple. How much your money can buy. $10 in 1990 could fill a grocery bag. Today, that same $10 might get you a loaf of bread and a drink. Nothing changed about the number 10. The change happened in what it can buy. That gap is where your wealth silently disappears. Governments rarely admit this openly. Instead, they point to things like temporary inflation, global instability, or market fluctuations. But once your purchasing power is gone, it does not return. No policy, no stimulus check, No election cycle can restore the real-world buying strength you've already lost. And the danger doesn't stop there. When purchasing power drops, your savings weaken. Your future dreams, a home, retirement, your children's education, all become more expensive and harder to reach. Currency devaluation forces you to work harder just to maintain the same life you already had. This is the trap. Your money looks the same on paper, but its real value is dying every day, silently and invisibly. One of the most subtle techniques governments use to mask currency devaluation is the illusion of economic growth. On paper, the economy looks like it's expanding. The GDP chart goes up, corporate revenues rise, and tax collections increase. But underneath this glossy surface, nothing real is improving. The numbers are rising only because the currency is shrinking. Imagine a country where a loaf of bread costs $1 this year and $2 next year. The government proudly announces that consumer spending has doubled. But in reality, people are not buying more. They are simply paying more for the same thing. This is how inflation becomes a political tool. It allows governments to publish impressive statistics without improving actual productivity or living standards. Devaluation also helps governments reduce the real burden of their debt. If a nation owes $1 trillion and the currency loses 20% of its value, the government has effectively erased a portion of its debt without repaying anything. But the money lost doesn't disappear. It is quietly taken from the savings, salaries, pensions, and purchasing power of ordinary citizens. This deception becomes even harder to notice because governments release the numbers they want people to believe. Official inflation rates are often dramatically lower than real-world price increases. Essential items, food, housing, fuel, are excluded or minimized in calculations to create the illusion that inflation is under control. The result is a population that feels poorer each year without understanding why. People blame themselves for not earning enough, not working hard enough, or not saving fast enough, never realizing that the rules of the game are being altered by those in power. In the end, hidden devaluation becomes a silent tax. It allows governments to claim success while quietly draining wealth from the public, 1 percentage point at a time. Most people don't realize they're losing money until it's too late. Prices rise, savings shrink, and suddenly the same salary buys far less than it used to. But even though you cannot stop governments from printing money or devaluing currencies, you can protect yourself from the silent theft happening in the background. The key is to stop thinking like a saver and start thinking like an owner. In a world where inflation and currency devaluation are constant, holding cash is like holding melting ice. It looks solid until it disappears. The first step is diversifying your store of value. Historically, assets like gold, real estate, productive businesses, and even digital assets like Bitcoin have offered shelter during monetary storms. The idea is simple: own things that governments cannot print. The second step is income protection. Relying on a single job or single paycheck is dangerous when inflation rises faster than salaries. Building multiple income streams, freelancing, online skills, small digital products, investing in dividend stocks, acts like insulation around your financial life. Third, learn the basics of macroeconomics. You don't need to be an expert. You just need to understand how money moves. When you understand the incentives of governments and central banks, you can anticipate the next wave instead of being crushed by it. Finally, prioritize financial agility. Keep your expenses flexible, your savings strategy dynamic, and your opportunities global. In a world where currencies weaken, adaptable ITY becomes the most valuable asset you can own.